Hi, I'm Adrian. Welcome back to Premium Logic Lab. Today I want to address what just happened in gold and silver because the move was violent, emotional, and very easy to misunderstand. When markets move like this, most commentary becomes one of two things: either a neat story that isn't fully true or a conspiracy that can't be proven. So let's do this the premium logic way. We separate what we can verify from what we can't, and we focus on structure, not drama. Here's the clean version. Yes, there was a headline catalyst. Reports linked last Friday's sharp sell-off to the nomination of Kevin Warsh as the next Fed chair, which pushed the U.S. dollar higher and shifted interest rate expectations. That can pressure precious metals. But the scale and speed of the move tells you something else was happening under the surface. The bigger driver was leverage. After a very strong run, positioning became crowded and leveraged, and then CME raised margin requirements on precious metals futures. This matters because futures markets are built on collateral. When margins rise, leveraged traders have two choices. One, add more collateral immediately, or two, reduce positions. In a fast-moving market, many can't add collateral in time. So they sell quickly, often, whatever they can. That's how you get forced liquidation. That's how you get a cascade. This is also why you often see everything get sold during a margin shock. It's not always a statement about fundamentals. It's often a statement about survival. Now, you may have heard chatter about large institutions covering shorts into the panic. I can't verify that. So I'm not going to claim it as fact, but I will say this: when you see a move this extreme, rumors always appear. Treat that kind of talk as noise, unless you have hard data. What matters more is what's still true after the liquidation. So let's talk fundamentals, especially for silver. Silver is not just a precious metal story. It's also an industrial metal. And longer-term industrial demand has real support from technology trends: electronics, electrification, and solar-related uses. Industry groups continue to highlight silver's importance across these sectors. So the key question is not, did the market sell off? The question is, did the structural demand disappear? And from what we can see, not really. What did change is the leverage layer on top of the trade. That's also why you've likely noticed something else during periods like this. Physical markets and paper markets can diverge. In other words, you may see reports of strong premiums for physical silver in certain regions, while paper prices are getting hit by liquidation. I'm not here to tell you it's manipulation. I'm not here to tell you it's not. I'm simply saying, when leverage is forced out of paper markets quickly, paper prices can move faster than physical supply chains do. That creates gaps, and those gaps can be informative. Now, what happens next? Here's my view, stated carefully. First, the parabolic phase is likely over, at least for now. Not because the story is dead, but because leverage has limits. When margins rise and collateral becomes expensive, the market's ability to go vertical is reduced. That's not an opinion. That's how leverage works. Second, a violent liquidation does not automatically mean the long-term trend is broken. It means positioning got too stretched and the unwind was brutal. Third, if margins eventually stabilize and become normal again, you can see prices rebuild gradually over months or years, not as a straight line, not as a promise, but as a function of time, fundamentals, and a calmer leverage regime. So if you're watching gold and silver right now, the real skill is not prediction. It's scenario thinking. Scenario 1, this was mainly a leverage cleanse and prices stabilize and slowly rebuild. Scenario 2, macro conditions change materially. Rates, dollar, growth, and the whole thesis shifts. Scenario 3, physical tightness persists and premiums remain elevated, which creates continued tension between paper pricing and physical availability. Notice what I'm not doing. I'm not telling you buy or sell. I'm not calling a bottom. I'm describing how to think about what we just saw. Because if you can understand what margin shocks do to leveraged markets, you stop being surprised by moves like this, and you stop reacting emotionally. In the next video, I'll connect this back to our foundation series because this event is a perfect live example of what we've been discussing: probability, leverage, and trading psychology. Specifically, why being right isn't the point, and why sizing and risk management decide whether you survive the volatility. Thanks for being here.